In this video we are going to talk about dividend stocks to buy. So before starting this video, please like this video and subscribe to this channel for our future updates. In the financial world, dividend stocks are those that make monthly payouts to their shareholders, usually in the form of cash payments. When it comes to income, dividend stocks can be a valuable source of income, but the finest dividend stocks can also serve as excellent vehicles for building wealth over the long run. However, not all dividend stocks are good investments, and many investors aren't aware where to begin their search for high-quality dividend stocks. This in mind, the following are some dividend-paying stocks you might want to explore, as well as some of the most crucial characteristics to look for in high-yielding dividend stocks. Once you have a good understanding of how dividends operate, a few important factors can assist you in identifying excellent dividend companies for inclusion in your investment portfolio. Payout ratio. The payout ratio of a stock is the amount of money it pays out in dividends per share divided by the amount of money it earns per share. For lack of a better term, this shows you what percentage of earnings a company distributes to its shareholders. It is a good sign that a dividend is sustainable when the payout ratio is relatively low, for example, 60% or less. A brief history of raises. When a firm consistently increases its dividend year after year, it is a highly positive sign, especially when the company is able to do so even during recessions and other difficult economic periods, like as the COVID-19 pandemic. Revenue and earnings growth that is consistent. When looking for the finest dividend stocks to invest in for the long term, look for companies with a history of consistency in their operations. Erratic revenue, up one year, down the next, and earnings that are inconsistent across the board can be warning indications of problems. The ability to maintain competitive advantages over time is possibly the most significant characteristic. A sustainable competitive advantage can take many forms, including proprietary technology, significant hurdles to entry, high customer switching costs, or a well-known brand name, to mention a few examples. Produces a high yield. This is the last option on the list for a reason. Naturally, a higher yield is better to a lesser yield, but only if all four of the other requirements are satisfied. A high dividend is only as strong as the business that supports it, so compare dividend yields only after you have ensured that the firm is robust and the payout is stable, and then compare dividend yields again. Lowe's, NYSE. Lowe, the home improvement behemoth, may not appear to be a particularly intriguing investment. And that is correct unless you are a fan of dividend growth. The company has increased its dividend for an astonishing 46 consecutive years, and during the past decade alone, the payout has increased by a whopping 471%. The following is another crucial number that is favorable for Lowe's. The typical home in the United States is 37 years old. Lowe's will see a significant increase in sales from the next generation of do-it-yourselfers. Walgreens Boots Alliance, NYSE. WBA Walgreens, one of the world's largest retail pharmacy operators, is undergoing a huge transformation as part of its turnaround strategy. Among its ambitions is to reduce costs while increasing digital sales. Perhaps even more significant is the addition of full-service healthcare clinics in hundreds of its retail sites in the very near future. Being more integrated as a healthcare firm should help this already lucrative company become even more profitable, allowing it to increase its already generous dividend to even greater levels in the process. Walgreens stock has a dividend yield that is well above 3% at the time of this writing, as well as 45 years of yearly payout growth. There is a lot to appreciate about Walgreens stock for dividend investors. Realty income, NYSE smiley face. If you're searching for a straightforward approach to invest in high-quality real estate for both income and growth, this could be the ideal investment for you to consider. The company possesses a diverse portfolio of properties that are largely resistant to e-commerce, and it generates significant cash flow from tenants who sign long-term leases. Realty income is one of the newest members of the Dividend Aristocrats, having joined the index in January 2020 after achieving 25 consecutive years of dividend increases. Realty income is one of the most profitable companies in the world, along with 50 straight years of paying investors every month. Johnson & Johnson, NYSE. J&J Johnson & Johnson owns a portfolio of strong brands that manufacture products that people need, specifically healthcare items. Johnson & Johnson is headquartered in New York City. In addition to its well-known brands such as Band-Aid, Neutrogena, Tylenol, Zyrtec, Benadryl, and Johnson's, among others, Johnson & Johnson has large and consistently profitable operations in pharmaceuticals and medical devices, the combination of which has allowed the company to raise its dividend for 58 consecutive years. This breadth of offerings spanning consumer health brands, pharmaceuticals, and medical devices is unparalleled, and it has proven to be a tremendous profit generator. Target, NYSE, TGT. In the harsh world of cheap shopping, Target has constantly demonstrated that it does not need to compete on price in order to succeed. It has consistently outperformed its competitors in terms of profitability, boasting some of the highest gross and operating margins in the retail industry. At the same time, the company's focus on building its internet business and expanding its in-store services has allowed sales and profitability to continue to increase at a healthy pace. Target should be on the shopping list of dividend investors because the company has been growing its dividend for 49 years and counting. Brookfield Infrastructure Corp., NYSE, BIPC. This is the case with Brookfield Infrastructure, which owns water, energy, utility, transportation, and communications infrastructure throughout the world. Brookfield Infrastructure is headquartered in Toronto, Canada. These assets generate consistent, recession and inflation-resistant cash flows, and Brookfield distributes a significant amount of these proceeds to its investors. Brookfield Infrastructure, with a dividend yield of more than 3% at current prices and an objective of increasing the distribution by 5% to 9% yearly, is a dividend gem that is often overlooked. Microsoft, Nasdaq, MSFT. It has become one of the world's most valuable firms. The company's emphasis on recurring, or subscription-based, revenue sources makes it a particularly attractive investment for dividend investors. The company has a strong financial sheet, with more cash on hand than debt, and a relatively low payout ratio, which means there is plenty of space to raise the dividend in the future. Given Microsoft's 19-year string of dividend growth, we wouldn't be surprised if the company joins the ranks of the dividend aristocrats in the near future. American Express, NYSE, AXP. American Express, NYSE, AXP, is one of the best. Amex, while not a member of the dividend aristocrats, has a decades-long track record of either increasing or preserving its dividend in every economic situation. Because of its high-quality lending standards and its focus on higher-income users, which are less likely to default on their obligations during periods of slow economic growth, the company has been able to achieve this success. For long-term investors, this means that it is both a safe investment and a reliable source of dividend income. Clearway Energy, NYSE, CWEN. A renewable energy is typically thought of as a destination for growth investors, but it may also be a great spot for dividend investors to invest in as well. Clearway Energy, which owns and runs utility-scale wind and solar assets, is a good illustration of how this may be done effectively. The corporation invests in, purchases, and operates these facilities, selling the electricity generated to utility companies under extremely long-term contracts. For those seeking a less volatile and more secure way to earn from renewables, Clearway Energy is an attractive option. ExxonMobil Corporation, ticker XOM. For the main oil and gas firms, the last 7 years have been difficult. Due to the collapse of the oil price in 2014, the majority of energy corporations have been forced to reduce their payouts as they struggle to stay afloat. The only exception was ExxonMobil. Despite a short-term drop in revenues, management has maintained its substantial dividend payout policy. ExxonMobil has also maintained a significant level of investment in new oil, gas, and refining projects. This includes, among other things, the offshore Guyana oil field operated by ExxonMobil, which has emerged as one of the industry's most important new energy assets. The fact that ExxonMobil made investments throughout the business cycle, while most of its competitors cut back, means that the corporation is now in an excellent position to benefit from the current rise in energy prices. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.